Welcome to Uncovering Trusts, a podcast by Edison Group. I'm your host, Will Manuel, and today I'm joined by Milosz Papst, Director of Investment Company Content at Edison, who will talk about the Diverse Income Trust, whose ticker is DIVI. Milosz, thanks for joining us today.
Hi, Will. Great to be here.
Great. So it's about 10 months since our last discussion on DIVI. We'll call it DIVI. So probably good to start with a brief introduction to the trust.
Yes, absolutely. It is important to understand that DIVI is unique in that it offers investors a genuine all-cap UK equity income fund. It has two managers, Gervais Williams and Martin Turner at Premier Miton, whose strategy is to generate a dividend income stream that is more resilient and has the potential to grow faster than those of the trust peers. They believe that over time, this approach should lead to superior capital appreciation as well as steady income growth. In addition, a focus on income can generate good returns in different market conditions. Other things to consider about the trust are that there has been no gearing since the fund was launched in 2011, and there is an annual redemption facility. For 2025, the redemption point is 29th of August. And in 2024, the redemption was in May, and around 26% of the share base was tendered.
Okay, and can you remind listeners how stocks are selected?
Yes, the managers employ a bottom-up stock selection process. Based on thorough fundamental research, they seek companies that can generate sustainable cash flows to support DIVI's growing dividend payments. Smaller cap businesses are favored as they are often under-researched and may be underpriced. The managers use a so-called traffic light system, so red, amber, and green, to assess companies based on 5 key questions. Firstly, are there prospects for rising turnover? Secondly, can corporate margins be sustained? Thirdly, is the manager team good enough? Then how much financial headroom is there in the balance sheet? And finally, whether the share price reflects low expectations.
Okay, thank you. So also it might be interesting to focus on the importance of one-to-one meetings as part of the research process.
Sure. DV's managers believe that they add value via their extensive one-to-one meetings, typically well over 500 a year. These include meetings with company CEOs and CFOs, where they can ask more probing questions and understand their attitude to risk than they would be able to do in a group setting. Also, meeting with the company's customers, competitors, and suppliers provides a broader perspective on how well the firm is operating in the current market conditions.
Right, that's pretty comprehensive. So following on from that, can we focus on the main features of Divi's portfolio?
Yes, with pleasure. The trust is one of the smaller funds in the 18-strong AAC UK equity income sector. As its name suggests, the Diverse Income Trust has a fairly long stock list of around 100 names. Being diverse means that trust is not over-reliant on a small number of companies to generate its income, while if a position is unsuccessful, it is not large enough to negatively affect the whole portfolio. DV's managers are unconstrained by index considerations and have a variety of options when seeking companies that can contribute to the trust's income stream. These may be mature businesses with surplus cash available to fund sustainable growing dividends, AIM-listed companies that are dominant in their respective fields, enabling them to generate surplus cash and superior dividend growth, and businesses where a long investment phase has come to an end, paving the way for substantial future cash flow and dividends. The portfolio is split broadly 20% large cap stocks, 23% mid cap, 55% small cap, and 2% cash. DIVI has exposure to all 11 market sectors, the largest being financial stocks, which make up more than a third of the portfolio. The top 10 holdings make up around 25% of the fund, and the largest position at the trust's year-end was Galliford Try. This is an interesting name, as it is a profitable company whose market cap had fallen to a level below the amount of cash on its balance sheet. However, it passed all 5 of the manager's traffic lights on green. Galliford Try is the leading UK construction group with a strong franchise in water infrastructure. With a robust balance sheet, it has been able to use its excess cash flow to pay a good and growing dividend, and in 2022 started a share repurchase program. As the share buybacks ramped up, it was able to more than cover any selling pressure, which has led to considerable appreciation in its share price.
Okay, that's really interesting. So, um, moving on, given the trust's income focus, it'd be interesting to know more about its dividend history.
Of course, since the fund was launched, DIVI's dividend has increased each year, compounding at an average annual rate of around 6%. The trust dividend is fully covered in normal market conditions. There was just one exception during COVID when the FY20 annual payment was 0.9 times covered, and there was a small drawdown from reserves in FY21. Based on its current share price, DIVI offers an attractive above market yield of around 4.5%.
Okay, great. So, if we could sort of step back a bit and maybe give some more background, can you share some information about the UK market?
Yes, good idea. Despite the headlines about UK companies quitting the domestic market, the UK has a very large number of listed companies across the market cap spectrum, which provides DV's managers with a very large pond in which to fish. It should be remembered that small cap stocks, with their greater growth potential, have outperformed over the long term. The managers explain that this is known as the small cap effect, where the returns of quoted companies are broadly inversely related to their market caps.
Right. And so, can you talk a bit about income versus capital growth in terms of total returns?
Yes, so it is interesting to know that since the trust launched in 2011, UK income has dwarfed capital growth. This is unlike in world markets where capital growth has led total returns. DV's managers contend that good and growing income should become more important versus capital growth, especially in the current uncertain macroeconomic environment. They believe that the Goldilocks scenario of economic conditions that were just right and assets that delivered above average returns has come to an end. So the managers anticipate a shift from mega cap into income stocks, which should also filter down into small cap companies.
Right. And so, following on from that, what are Divi's managers saying at the moment about the outlook for the UK market?
Given the UK is dominated by equity income stocks, UK market fluctuations are not that closely correlated with other major markets, including the US. Also, when the global economy is weak, companies that can generate surplus cash, such as many UK listed businesses and those in DV's portfolio, tend to be more resilient. Hence, the worse economic conditions get, the greater the advantage of surplus cash flow. As weak companies pull back to their core operations, financially strong corporates can expand into the vacated markets. During recessions, these robust firms can sometimes acquire over-leveraged but otherwise viable companies from the receiver, sometimes for a nominal sum such as £1, and greatly accelerate their earnings growth. As a result, stock markets like the UK can substantially outperform international comparatives and have done so in the past. For example, the UK significantly outperformed the US market between 1965 and 1985. Wrapping up on a particularly high note, Gervais has been quoted as saying he thinks that given current market conditions and the fact that UK equities remain attractive valued, UK equities, particularly income stocks, now offer their best risk-reward environment in 30 years.
Okay, wow, that's really saying something. So, really, time to take a look. So, thanks, Milosz, for that really interesting update. If the manager's views play out, Divi's income and multi-cap focus could be a really powerful combination. Um, so, you've been listening to Uncovering Trusts, a podcast by Edison Group. If you want to find out more about Divi and other investment companies that we cover, please visit www.edisongroup.com.